There are many amazing companies that pay dividends, but there's one trait that separates the best from the rest. In this video, I'm going to share the 2 best dividend stocks to hold forever. These dividend stocks have a remarkable competitive advantage that secures their dividends and provides plenty of room to grow them. The first dividend stock is Microsoft, ticker symbol MSFT. Obviously, Microsoft is a technology juggernaut, but to truly appreciate what makes it a phenomenal business, you have to understand the enormous value the company captures both now and into the future because of Metcalfes Law. Metcalfes Law attributes a value to the network effect phenomenon. Network effects are one of the best ways companies create defensive moats in the digital age. According to NFX, a leading venture capital and private equity firm, the simple definition of network effects is that they occur when a company's product or service becomes more valuable as usage increases. They go on to say, network effects seem deceptively straightforward, but when you take a closer look, you start to notice that different types of networks are very different in how they behave. As a result, not all NFX are created equal. Some are stronger and tend to produce more value than others. The firm has thus far identified 15 different network effects as shown in this diagram, and according to their research, 70% of the value in tech companies these days is driven by network effects. So there are many different types of network effects, and companies with the strongest types, like Microsoft, tend to offer extraordinary value to their customers. But the question is, how do you assign a value to a network? Robert Metcalfe, who helped create the internet in the 1970s and co-invented the Ethernet, proposed that the value or utility of a network is proportional to the square of the number of users. To illustrate, if you only have 2 users, the connection value is 1. With 3 users, there are 3 connections. With 4 users, there are 6. 5 users, there are 10. Once you get to 12 users, you have 66 connections, and the value continues to grow geometrically, even though the cost of adding each additional user grows at a constant rate. Metcalfes Law is arguably one popular way, but not the only way to calculate the value of a network. There's Sarnoff's Law, and there's also Reed's Law, which argue that Metcalfe underestimates a network's value because of small clusters in the network that scale faster than the network itself. However, the most important takeaway here isn't about which approach is right, but the idea that the more users a network has, the more it will attract new users, perpetuating a cycle that grows a network's value and utility. And so to bring this full circle, Microsoft is one of the few companies that has mastered several network effects simultaneously at a scale that is unstoppable. The company segments its revenue into 3 categories, and each of them leverage enormous network effects. Under productivity and business processes, this includes Office 365 and peripheral subscriptions, which based on NFX's definitions will be considered a protocol network effect, one of the strongest network effects around. Protocol networks are defined by a standard by which information is conveyed. Think Microsoft Excel, Outlook, and the full suite of productivity tools that are ubiquitous to any job that involves a computer screen. Not only that, the company's $26.2 billion purchase of LinkedIn back in mid-2016 expanded its dominance in the workplace by owning the biggest professional network and marketplace in the world. With LinkedIn, Microsoft captures the huge value of a personal network effect. Again, another robust effect characterized by business and reputational connections that make it nearly impossible for users to leave the platform. As of the most recent quarter, top-line revenue for this segment grew a staggering 15%, driven by Office 365 and LinkedIn. For comparison, Fortune.com ranked AppFolio as the fastest growing company in 2020. And in its most recent quarterly filing, the company grew year-over-year revenue by only 9%. 9%. Microsoft, one of the biggest companies in the world, is growing this segment like as if it were a startup company. And it shouldn't come as a surprise knowing Metcalfes Law. Just look at Microsoft 365 subscriber growth. This past year, it grew its user base by 27%. The year before that, it grew at 16%. And the year before that, it grew 12%. Subscribership is growing at an increasing rate, just as Metcalfe predicted. In the meantime, operating expenses only grew 4% back in 2019, and that remains true in 2021, although some of the lower savings is attributed to COVID. Now, altogether, operating income grew 26% year over year, with gross margin increasing 15%. For comparison, the average S&P 500 operating income growth rate was 17% over the same time period. That's almost a 10% difference. But the crazy thing is, this segment isn't even the company's highest margin or fastest growing segment. By far, the biggest and most important area of growth for the company is in its intelligent cloud segment. This includes server products and cloud services like Azure, SQL Server, GitHub, and supporting services. The revenue for this segment grew an astonishing 23% year over year, with operating income growing 41% off of a massive 27% gross margin. And with operating expenses only growing 12%, it shouldn't come as a surprise that Microsoft is a cash flow monster. In the most recent quarter, it generated $22 billion in free cash flow from operations, only $0.5 billion of which was needed to service its debt, and with only $5 billion reinvested into the business. It returned the majority of the cash to shareholders in the form of stock repurchases and dividends. So it's a no-brainer that Microsoft's dividend is safe with a cash flow payout ratio of around 23%. But there's two things you need to keep in mind. First, if you weren't aware, Microsoft only pays out a 0.85% dividend, which is really low. The company has grown the dividend for 17 years straight, and in the most recent 5 years, it's grown the dividend by nearly 10% annually. But for most people, it's going to take a while to live off dividends from Microsoft. Second, there's a lot of chatter around antitrust laws as lawmakers take aim at big tech companies like Amazon, Apple, Facebook, and Google. While Microsoft looked like it was getting a free pass, one top Republican is looking at throwing the company into the mix, and only time will tell where this could end up. As for its valuation, the company stands at a trailing 12-month PE ratio of 36, and it's generally been rising over the past decade. This is true for its closest peers like Google, which stands at 33 currently, and the overall market stands at 45 right now. But considering interest rates have been at historic lows, the Fed has pumped trillions of dollars into the economy, and more money has entered the stock market this year than the last 12 years combined, these record high ratios shouldn't come as a surprise. Also, from a technical standpoint, you can see that Microsoft's stock price rarely deviates from its moving averages. So you could be waiting a long time if you're looking to buy into the company at a discount. Now, if you're interested in investing in Microsoft or the next dividend stock, Webull offers 2 free stocks worth up to $2,300 for opening an account and depositing $100. Webull is an online trading app that is commission-free, no minimum deposits, there's no cost to use the basic service. It's an easy way to get free money to start investing. So get your free stocks now by using the link in the description, and by doing so, you help support this channel, so thank you. The next dividend stock is none other than Visa, the payment processing giant that does much more than process payments at the checkout counter. The company is embedded in nearly every aspect of the payment ecosystem in over 200 countries, from fraud and security management to economic forecasting and machine learning. Its biggest competitor, MasterCard, is nearly identical in most respects. However, Visa has more cards and greater transaction volume by a 2-to-3 and 1-to-2 ratio respectively. This translates into Visa earning more revenue, and because it has more economies of scale, a better operating margin. So while I'm going to focus on Visa in this video, I don't think any less of MasterCard, and I think both companies are excellent long-term investments. Before moving forward though, we need to be clear that these are not credit card companies or banks or lenders. At its core, Visa is a tech company that facilitates digital payments through VisaNet, a transaction processing network that authorizes, clears, and settles payment transactions. Credit cards that have a Visa logo simply indicate that the issuing bank or financial institution has a contract with Visa to allow those cards to operate on its network. According to NFX, Visa's core business captures the value of a physical network effect, like the card readers and connections and servers that require billions of capital investment to build and maintain, but also the value of a two-sided marketplace network effect, which are characterized by buyers and sellers that come together to provide value to each other through a network marketplace. Visa's transaction system, as shown by the central node here, is obviously the intermediary that brings sellers and buyers together. But there's another network effect that is critical for the marketplace to function. Visa's transaction system is only valuable if sellers and buyers can trust that transactions are not fraudulent. It's something we take for granted each time we swipe or tap the pay button, but the marketplace won't work without what is known as the data network effect. As Visa collects more data from its users, it improves the company's fraud and detection capabilities, thus making the system more robust for legitimate business activity. Now, Visa has been around for more than 60 years, and it might have you believe that there's not much expansion to be had. However, according to the company's 2020 annual report, Visa sees significant opportunity for continued growth. It estimates approximately $18 trillion in consumer spending is still done in cash and check that is ripe for digital adoption. That's 1.5 times Visa's payment volume today. And this is just on the consumer payment side. There's a whole different arena of payment flows it calls new flows, involving people to people, business to customers, governments to consumers, and more, where demand for Visa's infrastructure and capabilities could help unlock a $185 trillion opportunity, the majority of which is expected to be business to business. But Visa is obviously not the only player, and MasterCard isn't its only competitor. With the growth of fintech startups disrupting traditional banks and financial institutions, Visa is not immune to the rapid changes occurring in the industry and has taken aggressive steps to keep up. In late 2020, Visa launched its Fintech Partner Connect program and continues to expand its reach into the US and beyond. The program aims to connect Visa's bank partners with fintech companies to reach new digital customers. In a sense, another market network effect that Visa hopes will allow it to capture some of that $185 trillion opportunity. Another program is the Fintech Fast Track that makes it easier for startups to work with Visa to roll out their products, and this has grown 360% year over year, with hundreds of fintechs engaged in the program. Over the last decade, the company's revenue has grown at a 7.7% compound annual growth rate, but more impressively, its net income has grown faster at a 12% rate. That combined with a 63% operating margin makes Visa another cash flowing juggernaut. Basically, for every dollar in revenue, the company keeps 44 cents, and that rate has increased over the last decade. Just like Microsoft though, Visa only pays a dividend of 0.53%. However, over the last 10 years, the growth rate has been a staggering 24%. It went from paying 17 cents in 2011 to $1.22 in 2020, a more than 7-fold increase. And it can likely continue to maintain double-digit growth, considering it only paid out $2.7 billion in dividends from $9.7 billion in free cash flow, a mere 28% payout ratio. Now, both Visa and MasterCard are at peak valuations, even higher than the S&P 500, and with MasterCard trading at a higher premium than Visa. However, just like Microsoft, it is rare for either company to trade at a significant discount. As seen here, Visa's price never strays very far from its moving averages. Other than at the bottom of the COVID crash, there really hasn't been an ideal entry point to buy the stock from a technical perspective. So as long as you plan to hold on to this company for a while, I think it's hard to go wrong with such a quality company that dominates its market with incredible cash flow and a solid dividend track record. If you found this video valuable, be sure to hit that like button, subscribe to the channel, and hit that notification bell so you don't miss out on future videos. Thanks for watching, and I'll see you guys next time.